Have you ever wondered how banks seem to create money out of thin air? Today, we'll dive into this magic trick and discuss its pitfalls and the potentials of alternative systems. Every time someone gets a loan from a bank, money is essentially created. But how? Meet Alex. Alex borrows $10,000 from the bank. Instead of taking money from someone else's account, the bank simply updates its digital ledger. This is called fractional reserve banking. Here, banks only need to keep a fraction of their deposits on hand. The rest can be lent out, creating new money. From the Bank of England, 3% of the money in the economy is currency and 97% is bank deposits, which are mostly created by commercial banks themselves. Commercial banks create money in the form of bank deposits by making new loans. When a bank makes a loan, for example, to someone taking out a mortgage to buy a house, it does not typically do so by giving them thousands of pounds worth of banknotes. Instead, it credits their bank account with a deposit the size of the mortgage. At that moment, new money is created. For this reason, some economists have referred to bank deposits as fountain pen money, created at the stroke of a banker's pen when they approve loans. But this method isn't flawless. When too many loans default, or when there's a bank run, it can lead to economic instability, inflation, and the devaluing of currency. Furthermore, the individual taking out the mortgage will have to work maybe 25 years to pay off this mortgage plus interest, whilst the bank created this brand new money out of thin air in milliseconds. Furthermore, commercial banks create money when they make loans, and then they delete money when the loans are repaid. So what's the solution? Some suggest the sovereign money system or the Chicago plan. In the sovereign money system, only the state or a central authority can create money, not commercial banks. This ensures the money supply is in line with the actual needs of the economy. The Chicago plan, conceived after the Great Depression, has a similar idea. Banks should have 100% reserves against their deposits, limiting their power to create money. Both these methods aim to reduce boom and bust cycles, diminishing the risk of bank runs and ensuring a stable economy. It would be possible to increase the money supply without encouraging people to borrow to the utmost degree. It would also end too big to fail banking. But like all systems, they too have their criticisms. Implementing them would require radical changes to our banking infrastructure. Transition to a system in which money creation is separated from financial intermediation would be feasible, albeit complex. Whether we get a new system will depend on further study as well as a widespread consensus on the urgency for reform. When the next crisis comes, and it surely will, we need to be ready. Money creation is a powerful tool. While the current method has served us for centuries, it might be time to reevaluate and consider alternatives. For a secure economic future, we must be open to change.